There we go. Good evening, everybody, and welcome to the very first masterclass for 2026. So, this is going to be absolutely fantastic. I can't wait. And yeah, as we get into the session, there's obviously a few things we just have to cover, and then we can get going. So, I don't know why I have this frame. Anyways, uh, all good. Anyways, as I said, welcome. Tonight we are discussing the Wyckoff trading strategy, and we are going to go into quite a bit of detail on this specific topic just now. So, obviously, as we get into the session and as we are getting started, kindly just familiarize yourself with the risk disclaimer that is currently being displayed on your screen. It obviously just states that everything that I will be sharing with you during this session here today is for informational purposes only, and at no point in stage during this session will I be providing financial advice. As long as we are all clear on that, this is going to be an absolutely fantastic session. And well, we are going to have a lot of fun. So let's get started. Obviously, if you guys have any questions, please feel free to ask. You can do so in either the Q&A section, or you can, there's a chat section too. You can send me a message in either, and then we can take it from there. So, yeah, as I said, today is based on the Wyckoff trading strategy, and obviously, this trading method we here to look at, understanding, and as a trading strategy in the traditional sense, this isn't really that. But it's a framework, if I can put it in such a way, for reading markets. That's what the Wyckoff is all about. It's a framework for reading markets. This is an approach that helps traders to understand why proves price moves, not just where it moves to. Okay. So that being said, let me see if there is any questions that has come through as yet. I do see uh there there is quite a long hello. Okay. I guess someone added their AI assistant to take note. Hey, if you want to take notes, I am happy to that you can do that, and I have no problem with that whatsoever. So, with that being said, today's objective is not to teach you how to win trades, but to help you think more clearly about market behavior. So, let's quickly set some expectations for today. We'll begin by answering a simple but important question. What exactly is the Wyckoff method? That's where we're going to start. From there, we'll explore the ideas that markets move in cycles and not in random chaos. We'll then break down the four key phases identified by Wyckoff and explain what typically happens inside each phase. We will spend a meaningful amount of time on accumulation and distribution because these are the phases where most traders normally struggle and where most mistakes are normally made. And then finally, we'll discuss how traders can apply Wyckoff's principles. Practically, we'll also look at some practical charts. So I'll pull up a gold chart for all of you as well. And we're gonna have a look at that as well. So, and apart from the practices as well, we especially want to focus on identifying why the principles that Wyckoff discussed particularly comes down to patience and context in what the market is doing, and then obviously discipline. So this webinar in essence is, or this masterclass is designed to assist you in slowing down, mentally so you can think more clearly, um, not speed things up. Okay. So here's your first question for the evening, and I hope I'm going to get a bunch of answers in the either Q&A or chat section, just so we can have some interaction. I mean, traders, please, I'm not here tonight to just sit and talk to myself. I'm here to educate you on the specific trading strategy, but I'm also here to interact and engage with each and every one of you. So tell me, how many of you feel that you often enter trades after the main move has already happened? Let me know. I'll be very, very excited to hear you guys answering that specific question. While you do that, let's move on to what is the Wyckoff method. So, the Wyckoff method was developed by Richard Wyckoff, one of the pioneers of technical market analysis. Wyckoff believed that markets are not driven by indicators, patterns, or emotions alone. He stated that they are driven by supply and demand, controlled largely by participants with significant capital. So, his entire theory to trading was, instead of asking what indicators should I use, Wyckoff asked who's active in the market and what are they likely doing. So the method focused on price behavior over time, particularly during moments when price stops trending and begins moving sideways. Wyckoff recognized that these sideways periods are rarely random. They often represent preparation, either for a further rise or a further decline. This is why Wyckoff is not about timing entries perfectly, it's about reading intent. At at the core of the Wyckoff strategy is a very important mindset shift. Markets do not move randomly and they do not move because of indicators. Markets move because participants act, and large participants must act in stages. So Wyckoff observed that markets tend to move in cycles, periods of preparation, followed by periods of expansion. Sideways markets, which I know sideways markets frustrates most traders. And when I just started trading, they frustrated me too. And, as traders, we are often left behind by not understanding that these sideways markets are often the most important part of the cycle. They are where positions are built or reduced, where, you know, trends, whether bullish or bearish, are results, not starting points. Okay. So this is kind of what Wyckoff assists with. So when you see a market trending, it's, you know, like stated, that trending market, that's the result. Wyckoff kind of gives you the launch pad. Okay, and that's kind of what we're going to be focusing on a lot tonight. So if you only focus on trends, you're always reacting late. Wyckoff teaches us as traders to focus on what happens before the trend begins. Okay. So Second question for tonight. When markets move sideways, do you usually feel confused, or do you see a potential opportunity? So when you start seeing that market moving sideways, does this leave you feeling confused, or are you one of those traders that's the moment you click that, there's potential opportunity here for me if I am able to stay patient? I would love to hear from you in the comment section. So, let me see here. Oh, here we go. Robert just said good evening. Good evening, Robert. Welcome to tonight's session. So happy to have you here with us tonight. Let me close that out. So the four Wyckoff market phases, okay? So Wyckoff identified four repeating phases that appeared across all markets and timeframes. These phases form a continuous cycle where we have accumulation, markup, distribution, and then markdown. Once markdown completes, the cycle often starts all over again. So the key is that price does not jump randomly between these phases. There's a logic and a structure behind each transition. And for us, understanding which phase the market is currently in gives you context, and context reduces emotional decision making. So let's kick things off. And here you can obviously just quickly show you as well. So this is just an example of the accumulation, then the markup, then distribution, then markdown, and then normally again, we'll start again, accumulation, markup, distribution, markdown. So not just one straight trend, but showing you how to break down the trend and then capitalize on these mark up or mark down phases. Now, with that being said, focusing on accumulation. Now, accumulation, this is where the trend is born. Accumulation typically occurs after a sustained decline. And at this stage, selling pressure begins to weaken. Price no longer falls aggressively, but instead moves sideways within a defined range. Now, there, this is where many traders start losing patience. There is no excitement in the accumulation phase, no momentum, and no clear direction. However, from a Wyckoff perspective, this is often where informed participants begin accumulating positions very, very quietly. And you'll see that while these are forming, you'll find that there can be some false breakouts, below support or above the resistance. And that's why you'll see when drawing a Wyckoff accumulation section, it's not just one clear channel. You see, there's these additional breakout parameters to assist you from not getting caught in a false breakout. And again, just showing you different schematics of what is possible. It doesn't always have to look like this. It can look like this, or it can have, for instance, here you can see there's that falling wedge pattern. There can be various versions to how the accumulation phase looks And this is where that patience comes in to identify, okay, this is where my accumulation phase in. And then you can even see here at the bottom, you see phase A, phase B, phase C, phase D, and then at phase E, there's that full breakout. And again, this is where you apply that patience. And all phase A, B, C, and D kind of show you is when you get this initial breakout, it's not necessary to say that's where the trend is now all of a sudden changing. Apply a little bit more patience, give the market a little bit room to move, give the market time to, you know, pan out and accumulate enough orders so that you don't get into a position way too early or even get into a position that is moving in the opposite direction to what you are doing. So, you know, false breakouts, often referred to by Wyckoff as springs, are designed to remove weak holders before price begins its next phase. Now, what does removing weak holders mean? This is removing weak traders, those who lack discipline, those who lack patience. They get taken out by those false breakouts, those spikes in the market. And just as a question on this, how often do you actually get spiked out by the market because of the fact that you thought the trend was changing, but having a look, for instance, at that Wyckoff accumulation structure where it's not just two lines, it's four lines. So that little bit of extra room to just show you, markets can spike, and this is not the correct entry yet. And also allowing for various phases in the accumulation stage to actually see, wow, the market is moving in all of this, and then there's a breakout. So, how many times do you actually, in your own trading at the moment, think, wow, market's breaking here, and then market's not breaking yet? And I mean, last year we spoke about price action so many times, and Wyckoff fits in perfectly with that because the fact that, again, you need that change of character, you need that break of structure, you need that retest. And again, people are so often, the moment they see change of character, they want to jump into the market instead of waiting for more accumulation and then the break of structure and then the move continues. So I know we've been talking about this, for months. Okay, not Wyckoff, but price action. We've been talking about this for months. And my question is just, are you still getting spiked out? Are you still falling victim to that false breakout? Let me know. I would love to hear from you. So, just the key takeaway here for me is this, the absence of movement does not mean the absence of intent. So, just because there is no big moves or no clear momentum at the moment doesn't mean the market is not plotting something. It doesn't mean there's no intent behind what is coming. Because a lot of times we are so excited when we see a little bit of accumulation and then a breakout that we just want to jump into a trade, only to see price reversing shortly after, hitting our stops, and eventually, maybe an hour or two later, there the market goes, and then we're not part of it anymore because we entered too soon, we got tapped out, and what now? I love this answer. I find opportunity in sideways markets. I like that. Um, my stop loss normally gets spiked often. I do hope after the session tonight that that will happen less often, okay? By actually showing how to read markets a little bit better and how to allow price action to speak to you better so that you don't just get taken out for no apparent reason. Okay. Agreed that it's impatience. Okay. My setups on TradingView play out better due to discipline. Okay. Fair, fair. Again, traders, if there's any questions, please feel free to ask. I mean, there's quite a few people here tonight. I would love to get more interaction from everyone because, again, this session here tonight is for you. It's for you to kick off 2026 the right way so that your trading can give you the results this year that you truly want. Now, moving on to distribution. So we just covered accumulation. So now we are heading into distribution. Now, this is where trend ends. So accumulation is where trend begins, distribution is where trend ends. And, you know, distribution is the mirror image of accumulation. So after we see a strong trend, price stops moving higher or moving lower and it begins to consolidate near the top. At this point, optimism is normally very, very high, and many traders believe price will continue rising indefinitely. However, this is often where large participants begin distributing positions to late buyers. Okay. What does that mean? It means they are selling their positions to everyone who is late to the party. Okay. So everyone who showed up late, they are buying these positions. So again, false breakouts will appear. And these frequently occur during distribution. And again, just showing you some examples here. Here you can see again, there's your distribution phase, but just having that little extra layer. Because why? False breakout, false breakout, false breakout, false breakout, false breakout, false breakout, little bit of a retracement. Then the actual move takes place. And that's when we enter. That's when we participate. Again, here, look, false breakout, false breakout, false breakout, pullback, then the actual move. And even here, yes, here we had our rising wedge pattern even in there just to add a little bit of extra chart patterns. Because why? We said in the beginning that it's not just about patterns and indicators and so forth. All these things work great in combination with clean price action and phases. So again, here you can see false breakout, false breakout, false breakout, false breakout, and then the actual move. So I'm hoping I'm starting to make sense here. You know, these moves encourage buying those false breakouts only for price to reverse shortly after so more positions can be added by larger institutions. And if you understand this, and from a Wyckoff perspective, even distribution is not about predicting a top. It's about recognizing where demand is no longer in control. And I'm going to show you guys this live now on a gold chart. And to be very clear at the moment as well, when I show you as from my analysis, gold is currently in a distribution phase. So now we are waiting for that breakout so that next move can take place. And that's where we profit from the market. So, yes, okay. I'm getting ahead of myself. I really am. It's my first session for the year. Okay. It's my first masterclass for the year. I am super excited. I do see I have another comment here that says, makes perfect sense. I'm glad it does to someone. No, I appreciate the comment. Um, Absolutely. So I'm glad I'm at least explaining it correctly. Okay. So mark up and mark down phase, or our expansion phases, the parts where we actually trade. Now, markup and markdown phases are the phases most traders focus on because these are the phases where price moves decisively. Okay. So markup represents bullish expansion after accumulation. Markdown represents bearish expansion after distribution. However, Wyckoff teaches us that these phases are consequences, not causes. So if you understand what happens during accumulation and during distribution, markup and markdown becomes easier to contextualize. Okay. And it becomes less emotionally overwhelming. So tell me, do you tend to enter during strong trends, or do you try to anticipate reversals? Are you one of those traders that identifies trends and then trades with it? In other words, normally buying dips. But again, we don't just buy a dip, we buy a dip after that change of character, break of structure, and then we buy a dip. Or again, selling highs. Where do we sell highs? After change of character, break of structure, and then we sell highs. Or are you one of those traders who believe they can say, this is the bottom and this is where I'm buying, and this is the top and this is where I'm selling? Would love to hear. And again, judgment free zone. Okay. Why? Because I've done all of it. Okay. I have been the trader that thought they could predict markets, and now I'm the trader who just quietly sits behind charts, reading price action like it's my favorite storybook every single day, and just trading what the market gives me. And I promise you, my stress levels went from 110% to, probably around the 30% range at the moment. So at one point, I think I had serious chances of reaching extremely bad heart condition, or high blood pressure issues, where just by changing the way I look at charts and just having a much more patient and relaxed approach has made my life so much easier. And this is what I'm trying to get across today. So, you know, Wyckoff identified specific events that tend to appear within accumulation and distribution phases. These events help us as traders to evaluate the market, but also evaluates it in a very, very specific way, if I can put it in that way. Okay. So it assists whether supply or demand is dominant, whether a range is healthy or vulnerable, whether a breakout is genuine or deceptive. Now, something to understand here is, by you understanding these various aspects, these are not just signals, they are observations. The goal is to memorize labels, but to understand what price is attempting to achieve. Okay. And Wyckoff is most effective when applied with context and discipline. Okay. So, as always, higher time frames often make phases clearer and reduce emotional noise. Entries should always come after phase identification, not before. And as always, traders, risk management remains essential. Wyckoff does not magically eliminate losses. Okay, this is not what we are doing here tonight. It improves decision quality. And perhaps most importantly, Wyckoff requires patience. Many traders struggle not because the method fails, but because they abandon it prematurely. And those of you who've attended some of my masterclasses in the past, you would probably have heard me say the following before. If this is your first time, this is not the last time you're going to be hearing this. But I've said so many times that it's not our trading strategies that fail us. It's our ability to abide in those trading strategies that fail us. Abandoning trading strategies prematurely, that's what fails us. So tell me, how often do you review past trades to identify why a certain trade worked or a certain trade didn't? And going forward, I would like you to add a little bit addition to this now. So if you are currently reviewing trades, and again, I'm waiting for the answers, but if you are currently reviewing your trades, add an additional review in there. And the review is, what phase were you in when you entered set trade? Were you Did you perhaps enter the trade during accumulation or distribution and not correctly waiting for the markup or markdown phase? Let me know. Uh, I try to identify early as possible when I see MACD crossover at key support and resistance levels, and I look at volumes at higher time frames for confirmation, which is not necessarily a bad thing. Okay. Yes, you can use your indicators to identify certain high points and low points, but even if we're using other momentum indicators like stochastics or your relative strength index and so forth, these can stay overbought or oversold for a very long time. And this is normally where we would find those accumulation or distribution phases where the market is in. And by not waiting the appropriate amount of time, we enter into trades that we should not have. So I hope that makes sense. Um, what I want to do is I promised you guys live charts, and I want to show you gold. Okay, so let's head over to the gold chart. So here you can see here's my gold chart at the moment, and again, just identifying simple structures. And yes, you will see that accumulation or distribution phases don't always have to be horizontal. They can be slightly slanted. Okay. So for instance, let's start here. Here you can see here's that initial accumulation phase. And again, look, false breakout, false breakout, false breakout. And normally what I wait for is I wait for a break above a previous false breakout. So a nice clean close. And again, you can always see most of the time false breakouts have these wicks attached to them. And yeah, again, you can see wick, a little bit of a wick, straight pullback immediately, where a full on breakout has conviction to it. And from there on forward, my setups normally look as follows. I will enter, I normally put my stop around the middle of the actual zone, so that middle line there. And then you can easily aim for a 2 to 1 risk to reward ratio on this. And again, you can see by the time we kind of hit profit on that first trade, the next phase has already begun. And again, this is that distribution phase now. So again, markets moving within that false breakout again, little wick. And here we had false breakout, and then we had a breakout with conviction, but it didn't quite break lower than that previous low point. So for me, because again, there you can see that we had that move lower, but big wick. So, but then there was that nice little retest and the push lower. So for me, I would have entered around there back into the market again, placing my stop at that middle and then aiming for that 2 to 1 risk to reward ratio, which was achieved relatively quickly. And shortly after, again, everything exactly like how we discussed earlier, distribution, accumulation, markup, distribution, markdown. And what happens? Everything starts again. So, accumulation, false breakout, false breakouts, and here you had that break back. Again, you can see there's no clear conviction. There's your conviction trade. So again, from here, can nice safely enter stops around there, which is the middle, and a nice 2 to 1 risk to reward ratio. Beautiful large trade play out, and look where we are now. Accumulation, markup, distribution. False breakout. And again, we're still sitting here. So what am I waiting for now? I'm waiting for a nice, clean conviction breakout. And I'm waiting for it to break below that previous low point there. From there, I will look at a nice short position. Stops in the middle of that zone. 2 to 1 risk to reward ratio, which means I'm aiming more or less close to this previous support level with a nice little setup taking us back down to 4,465. So that's relative the setup that I'm looking and waiting for now, and just showing you exactly what we discussed tonight, just how that plays out. And again, these are my larger setups on gold that I normally use about the hourly time frame. It's a nice little time frame for me to utilize this specific trading strategy. You are welcome to go and test it on various other time frames that you might want to use. But to conclude, I do hope that what I just showed made sense, and that you could actually identify what we were talking about tonight. Okay, cool. Not a problem. I totally agree with you. I often review my trade history. I seem to get involved at accumulation phase as it seems. Okay. Thank you so much for that gold explanation. Only a pleasure. I'm glad to hear you found that beneficial. So, traders, as we kind of conclude, we've been going for 45 minutes. Doesn't feel like it. I've had so much fun with this first masterclass for 2026. But, you know, in essence, to conclude, the Wyckoff method is, this is not a shortcut or a promise of quick success. This is a framework for understanding how markets behave, how participants act, and how trends develop over time. So, if there's one takeaway from today's session, it's this: markets reward understanding far more than markets reward prediction. Okay. So I would encourage you to revisit your charts, study various market phases, and focus on recognition rather than reaction. That being said, thank you so much for attending today's masterclass. And again, next week we'll have a new topic. Please have a look out on our social media where we will share what next week's topic is. So this is either on Instagram or Facebook or X or whatever platform you would like to use. Our social media team is absolutely amazing with this, and they are fantastic at communicating this. Or for all ATFX clients, you will get an update next week during the market brief. So that actual email that gets sent out to everyone from that perspective, um, they will let you know there as well what the topic is for next week, and then we can take it from there. Thank you very much, Francois. It's only a pleasure. Thank you for your insights. Awesome. Thank you, thank you, thank you. So I look forward to seeing you all next week. Tomorrow morning, we have a live market brief. So, where we're going to analyze markets live together as well and look at various trade setups. So, if you're not registered for that yet, please reach out to your account manager to register for those sessions as well. Or you can email me. My email address is marketbrief@atfxafrica.com. So, traders, thank you. As always, stay sharp, stay focused, trade smart, keep learning, and have a blessed evening. I'll see you guys soon.